Well, good afternoon. Hopefully this audio will be coming through now. Okay, I hear myself now, so should be okay. I know some of you are going to be wanting me to pump up the volume, but as you can see, I just did as I normally do, and for whatever reason, YouTube likes to mess around with me with, with my audio. So they don't want you to know. They don't want you to know the secrets. Okay, that's what it is. Shh, don't tell nobody. Everything I tell you today, just keep it to yourself. Okay, it's a secret. All right. So anyway, today will be a rather brief one. Notice I didn't say short. Okay, it's going to be a brief one, meaning that I'm just going to cover some salient points, refer to some things in terms of processes and protocols for the afternoon session, and I'll stay with you probably till around 3 o'clock. Okay, so we'll aim to break away at 3 o'clock. All right. So if you recall, the last two live streams, I've had a casual introduction, kind of like warming you up to the idea of just relaxing when you're watching price. And then the second one, I gave you very specific things to look for. What does it look like on the chart? And now this one, we're going to talk about if you're going to be trading in the afternoon. I'm full disclosure. I'm trying to press my son Caleb into the morning session. Okay, so most of this mentorship is going to lean heavily on the 7 o'clock in the morning to 11 o'clock in the morning, New York local time. Okay, so inside that 4 hour window. And I'm going to leave it up to him to determine how his body behaves and how he feels in those early hours. Does he want to be trading as early as 7 o'clock as a start time, or 8 o'clock, or is he just going to simply wait for the opening bell at 9:30 and use that 9 o'clock to 11 o'clock 2 hour window there? So that part he's being afforded that decision. But as the dad, exercising my dominance and authority, I'm assuming that everyone understands that this stuff will work in the afternoon too. I'm going to give you those rules, but these are not for him. Okay, so Caleb, this is not for you, but it's for the sake of completeness. Okay, much like I'll show you how to do it in the London session as well. We'll do it over live data as well. But for the afternoon session, um, sometimes when you look at the economic calendar, there is an absence of any significant medium or high impact news events. And what do I mean by that? If you go to like forexfactory.com or Econoday, they give a really good breakdown of every single calendar day and what time specific market drivers come out. That means a speech, a market data release, like a report. Think like PMI, CPI, those types of things. When we have a day there that has an absence of any news drivers in the morning, that tends to be a rather lackluster, rangy type, false breakout, and then pull back down into the previous day's range type of day, or reverse if it's trying to move higher. So I try to look for reasons to anticipate an afternoon move, because the morning session can tend to be a little bit more. It demands a lot more experience. Let's put it that way, because you can get caught offside. You can think you see something that's there, trade it, and then it reverses and goes the other direction, or it goes into a consolidation. If you notice on today's calendar, and I'm going to leave this up for you as your own little homework assignment. It's not that challenging, I promise. Most of you are aware of it if you're a student. If you go to forexfactory.com and you pull up today's calendar, you'll see that there is a bond auction today at 1 p.m. Eastern Time. And I'm going to talk a little bit how to use that, how to trade it. I've never taught my students that, but it's something that it's not a terribly volatile report. It's not something that you're going to burn the house down with, but it is absolutely something that you can trade. It does give a little bit of volatility. It does give you a little type of momentum to work with. And if you have a little bit of a narrative, and I'll talk about that in a moment, you can find some setups. Okay. And I watched the piece by another YouTuber, Kimmel. Um, Very interesting video. I found it funny. But I left a comment on there so that way you know it's really me. ICT's a fake. Okay, he's a fraud. Hard pass. Anyway, all of the YouTubers that use me as a way to like pump themselves up, um, I'm I'm causing purposeful resistance for you. Okay, I don't mind you using my content, but I don't like using me as a springboard. That type of stuff. So if you have something you've been doing on your own with the things I've taught, then hey, I got all the respect for that. But if you're just trying to teach and you're not doing anything with it, Kimmel's proven he's made money with the stuff I've taught, so I got no problem with it. But the main thing is I don't want any of you, and especially if you're a new student here, don't look at me as a hero. Don't look at me as your guru. Don't look at me as your master. Okay. You're not here to worship me. You're not here to lift me up or promote me or anything like that. You're here just to learn. That's it. That's all it is. That's the economy here. You put in the time, I share what I'm willing to share, and then you put it to work. If it works for you, great. If it doesn't, there's plenty of other people out there to learn from. Okay. I'm not going to ask you for a PayPal payment. I'm not going to ask you for a credit card payment. I'm not going to ask you for a WhatsApp app payment. Nothing. It's all 100% for free. But one of his statements in there, he opens up his video with, and a lot of people have said this, that there is no guidance, there's no direction, there's no what to do. And I agree. I agree to some respect if you refer back to when I was teaching on baby pips, because it was meant to be like that. I wanted to see if I left some breadcrumbs, could I create this test tube response of other individuals watching what I was doing? And could they have the same result that I'd had and come to the conclusion of what I see in price? Could they do it? And no one's ever done it. Even still today, with even all the students I have, no one's ever been able to do that. So when I started doing mentorship, I started doing broad brush concepts and protocols. What to look for, where's the focus? Where should your focus be? Okay. And it started with time of day, London session, London open, and then New York open, London close, PM session for the American markets like the indices and such. And then I went into teaching very specific things, but they're tucked inside of all of the long-winded, dry commentary. That's where I tucked it in. I have taught how to trade very specific. Do this, do this, do this, do this, do this. Okay. And the reason why it doesn't feel like it was like that, because you all want me, and I had it in the previous video here, in part 2 of this mentorship. There's a lot of people saying you talk too much. You could just tell us how to do it in 5 minutes. I'm not watching your next video. Good, but I know you're here watching this one too. the the main takeaway is for you to, number one, understand that there has to be some reason for the setup to be there. Okay, and majority of your time as a trader is going to be spent waiting for that very thing to occur. Now, that's not to say that the market isn't moving all the time. It absolutely is. But just because it's moving and gyrating doesn't mean that you're supposed to be in that right now move. That right now move may be completely diametrically opposed to what you are trying to do for your trade, because your trade may span outside the realm of the next 20 minutes or the next hour or today's entire trading session. You may be trying to nail down a trade that goes for weeks. So there's a lot of room for you to make what it is I've taught your own. That way you can take it and apply it to the marketplace, a time frame, a scenario that you're looking for that meets and fits your personal, unique personal life, schedule, and the aptitude that you have using the information I've taught. So predominantly, most of my content is allowing and affording all of you as students to find your own mold, your own way of framing these things. Okay. And Kimmel, yes, I do have 81. And for the joker that left a comment in your thing, it's not 84, and it's 81 very specific PD arrays. And they are both entry mechanisms, they are partial mechanisms, and they're take profit mechanisms. Okay. I know sometimes people like to use reverse psychology, like I'm going to go out there and prove that I have, here's 81 of them. I'm not doing it. But I'll teach you one or two of them extra today just because I want to do it. But these mechanisms, okay, these little things, these little quirky little excuses to get into the trade with a precision element that's not linked to anything where I can say, I learned it from so and so's book or I learned it from so and so's course. It's something that's in price action. And when you observe it and you see it and you start seeing it a lot, and then you can anticipate, it should form when it does this, and it starts doing it, and you do it for 20, 30 years, you don't need to be convinced any further of it, right? So when we look at times of day, like I said, I'm pushing Caleb into the morning session. He may elect to go when he gets good at that morning session. He has to do that first. Then he can make the decision if he wants to go to an afternoon session or if he wants to trade the London session. But I'm going to force him and twist his arm basically that he has to perform in the morning session. That's his payment for me investing my time and energy and pushing him along. He has to do it there. So it's kind of like remember the movie Kill Bill? She went to train with the master, and he was going to put her through the ropes the way he wanted her to go through it. Well, that's what I'm doing with him, okay? Because he's going about this the second time around, so he's going to have to earn it a little bit harder. So morning session is his focus, but the afternoon session has its own characteristics as well, and just as much as the London session has its own characteristics. So if you are just looking for a way to get in the marketplace or how to trade and get in, you can clearly find that on my YouTube channel. It's absolutely easy. Silver bullet, optimal trade entry. Um, it's a matter of what is it you're trying to do. And if you go into the mentorship, which is all for free on this YouTube channel, you go into the playlist, you'll see it. It's divided by month. I will teach you very specific elements about short-term trading, day trading, swing trading, ultra short-term scalping, and they're very specific elements. But it's assuming that you have already done the work of looking at all of the broad brush concepts and modules that I have on this YouTube channel. For someone that's brand new, just stepping out and says, well, I'm going to watch 5 videos from ICT today, you're not going to walk away understanding it. You're not going to, all it's going to do is give you better foundation, one more cog in it, and those pieces come together when you sit down, like I was explaining yesterday, and in the first lecture as well, when we're watching real-time price action. You're not trying to hold your feet to the flame and say, I have to know what it's going to do right now. It's not realistic for you to have that at the early stages. And you got to give yourself permission to do that and have that peace of mind knowing that keep doing what I'm showing you how to do, and it will come by default. It will be a response naturally because you'll see these things repeating over and over and over again. And what will be exciting for you is that you see them occurring at the time of the day when they should occur, which removes the whole idea that the markets are ambiguous, they're random, and they're in no way, shape, or form not rigged when they absolutely, absolutely are. They really, really are. So maybe we first saw this live stream when I first tried to start it at 1:45. I noticed I couldn't hear myself, but I put the screen on so that way you could see the new day opening gap, high and low. And we're going to talk a little bit about that because Caleb, that's going to be like a lot of what you're aiming for as an underlying narrative. Okay, so while you may be aiming for an intraday, okay, or intra daily session, relative equal high or relative equal low, to draw to as an objective for your trade, it's going to be linked to a new day opening gap and or new week opening gap. And if this is the first time you've heard those terms, I will explain what they both are in this one and what you're going to be doing with them, Caleb. Okay, so we talked a little bit about how at 7 o'clock, at 8 o'clock, and at 9 o'clock, the immediate 30 minutes after that, or each one of those top of the hour intervals, we want to anticipate a opposing direction in the marketplace. So the assumption is you have already identified after 7 o'clock in the morning New York local time a relative equal high or relative equal low, or where price is smooth. Okay, and then you're anticipating, you're not arm wrestling the market, you're not forcing that it has to go there because you now see it, so therefore it can't do anything but go there. That's not what you're supposed to be doing either. which is why I taught you in the first two sessions together, is just to relax and observe. You have to observe. You have to sit back and watch what does price do and record your observations. If it means taking screenshots as price is going and moving around, and it may not be near anything of any particular importance, like an order block or a fair value gap or something like that. And no, Kimmel, an inversion fair value gap is not just a fair value gap. There's two distinct things going on there, but it's okay. It'll be in the book. The idea of you using these intervals as a starting point, a delineation in time. So, okay, now I'm really focusing. It's 7 o'clock in the morning. Whatever's happened overnight during London, whatever's happened in the previous day's trading, I'm not factoring anything in yet. I want to see the design, the engineering of liquidity. And what does that mean? When price creates these really smooth areas of relative equal highs or relative equal lows after a session changeover, meaning at midnight New York local time, that is the beginning of true day. That's the beginning of the real true day in financial markets. So the algorithm likes to refer back to that time, and then everything since that time, it'll refer to for the purposes of liquidity or inefficiencies. Outside of that, you'll have things like new week opening gap and or new day opening gap, which is what you see here on the chart. New day opening gap. What that is, and let me just maximize this chart. Well, actually, let me do it on a 1 minute chart because it'll be a little bit easier for you to see it. Every day, except for Friday, this is for specifically the index markets. Okay, so while I'm teaching my son how to trade and make money in that asset class, this is not something to lose your mind over. It's really simple. At 5 p.m., again, every day except for Friday, the market closes at 5 p.m. It stops and it pauses for an hour, and then it resumes at 6 p.m. Eastern Standard Time. If you take your 1 minute chart, you don't have to have live data to do this. It's something that is a long-term effect on price action. It'll be used for weeks, okay? And I'll explain it in a second. Here is the 459 candle on a 1 minute chart. My candles that are bullish are green, and my candles that are black are bearish. So the up close candle, that is the closing price where we stopped, and it's the last print for NASDAQ on Tuesday going into the 5 o'clock stop. And then at 6 o'clock, all you do is simply get in front of your computer, wait a couple minutes right before 6 o'clock, and wait for the first print on a 1 minute chart. When it opens up, that opening price, you drop a line segment on it, okay? And what I do is, all I do is I take this little line thing here, a horizontal ray, and I just go and I drop it on the opening price. And you can annotate it any way you want, okay? I know some of you folks that are on the other side of the pond, if you will, you don't like to see our numerical version of, like, today's date for me would be 08/07/24. And for you across the pond, you would probably see that as July 8th. And obviously it causes confusion. So I generally don't annotate it like this, but for the purposes of not confusing anyone and for completeness sake, when you highlight and annotate your chart, you have to do this. Okay, this is the part. If you just put these lines on your chart, and you're going to have about 5 of them, because you're going to use the present week, or if it's on the weekend, the new one that forms on Sunday's opening price. You annotate that on your chart, and then you'll have 4 more prior to that. So you're always going to have like a floating reserve on your charts of 5 weeks of new week and new day. I'm sorry, for new week opening gaps. 5 days look back for new day opening gaps. New week opening gaps is 5 weeks. So when we have these levels annotated like this, you can call it whatever you want. You can label it the way you want. But I taught my students that this would be referred to as the new day opening gap high. Now, why is that? It's the new day opening gap high because at 7 o'clock in the morning on Wednesday, and yes, that gap forms technically on Tuesday evening, my local time in the east coast of North America. But that's really technically a gap or inefficiency that is attributed to and should be used for the basis of Wednesday's trading. So it's a little confusing, but if you rewind that and listen to it again, it's pretty straightforward. But at 7 o'clock in the morning, there's 7 a.m. And if we scrub this down here, you can see that we are way above that new day opening gap. See that? And since this is the first level you would come to, that makes it what? The new day opening gap high. And then the next level below it, which would be whichever is the next reference point. You can have a gap. In this case, we have a gap that has gap down. So where we closed here on this candlestick there on Tuesday at 5 o'clock, we open lower. You see that? Now, when we drop down to it here, what we have done is we left this portion between this candle's low, or whatever this one is, whichever's lower, that little segment of inefficiency is still present. Because what is it lacking? What's it missing? Sell side delivery, not sell side liquidity, sell side delivery. Okay, so if you look at this candlestick here, we opened and traded up. So there's nothing passing down into that candle's low, or I'm sorry, the opening price. It's not offered yet. So when we annotate our chart like that, these gaps, okay, these gaps will be referred to for a week. Now, sometimes you'll see they actually get referred to a couple weeks later. Still, they'll be sensitive because they're real algorithmic arrays where the market will refer back to them. But I'm not going to be able to teach you every aspect about those things, because to do that opens a Pandora's box for me, and I'm not going to do it. Okay. The fact that these exist, and once they get traded to, anybody else that looks at gaps would think, okay, it filled the gap, and that's it. Throw it out the window. It's done. It's over. Kind of like how the myopic view of supply and demand, where they say, I need a fresh zone. Everything I serve up as a PD array is piping hot and fresh every single time. It doesn't get stale, okay? But for the rule-based idea trader in you, new day opening gap, this is the part where you write down your journal, folks, or your notes. New day opening gaps have a life cycle of 5 days, okay? You can use them longer if you want to. But for the teaching purposes, when I taught new day opening gap first, I taught it on Twitter. I introduced it there in Twitter Spaces, and I talked about it as a after fact and made its way into my lectures on the YouTube channel. They can act like magnets where it draws price back down to them, because these levels, these gaps, have real value in them, because there's an absence of any real trading. Even when you see them open up initially here, we can see that it opened there, it traded above the previous day's close, does so here, and comes back down, and then runs back up, stays around in here, runs back up, stays around here, drops, consolidates, drops a little bit, and leaves a small portion. If you take a Fibonacci, okay, if you take a fib and you drop it on the lowest open or close, let me say this part first before I get any further. If you look at it from here, I'm going to zoom in, use this little thingamajigging here. Zoom in real tight. Here's the closing price on the Tuesday at 5 o'clock. We opened down here, so that's a lower gap opening. The opposite would be this, where we opened above that closing price. So if we opened up here, then you would draw the same lines the same way, and you're using this ray down here that extends it in perpetuity. It keeps going to the right. It never stops projecting it to the right. And your annotations, when you annotate them, put it on the middle and to the right, and then you label it. Real important that you put the date in it. Whatever format you want to use, it's up to you. But that format or that date rather, helps you organize the level of importance. So what does that mean? If you have a new day opening gap, say for, I don't know, 2 months old, okay? 2 months old, and we haven't referred back to it since the day that it formed. And then in that instance, I would find it important. I have a journal page, a spiral notebook basically, and I write down every single new day opening gap, high and low, and its midpoint or consequent encroachment. And I'll explain what that is in a second too. And I keep a running log of that. And as long as we're 150 handles in close proximity to any one of them, then I personally will look at them. So I'm kind of like showing you my hand a little bit today. So for you, because it's something probably new to you, and you're probably going to have a whole lot of them on your chart because you're going to think that you have to have every single one of them forever. It's until you know, until you run away from all the ones that you're presently trading around. Um, you don't want to clutter your chart up, but I like to see them. And in my journal, it has a spiral, page that it's basically a column, and I write down what that market is, and it's usually just the S&P and the Nasdaq, and sometimes the bond market. The the high and the low and the consequent encroachment and the week that it opened up and formed. So for instance, this is for Tuesday, okay, on the day it formed. But is it for Tuesday's reference? No, it's for Wednesday's trading, and that's why it's labeled that way. Okay, so you're going to use the next day after the 6 p.m. candlestick. So if you look down at the bottom of the chart down here, it says Tuesday, August 6th. But really what we're doing is we're building a reference point for Wednesday's trading and for the next 5 days. So that means this will overlap into next week. 5 trading days, not 5 calendar days, 5 trading days. Okay. If you have a holiday, skip that and add one more day to it. And that's kind of like your life cycle for new day opening gaps. New week opening gaps go back with a life cycle of 5 weeks. So you're always going to have 5 weeks of new week opening gap. And a new week opening gap is where we stop trading on Friday at 5 o'clock, and then where we open up at on the Sunday at 6 p.m. And then you mark it the same way here. The only difference is you would say NWOG, which is new week opening gap. They tend to be very sensitive still 5 weeks back. Now, that's not it's ended at 5 weeks and you can never refer to them again, okay? It's just a general rule or principle that you can start with. You're going to discover that they work 6 months, 9 months still away because there are actual places where the market didn't really efficiently trade, as I'm showing you here. But if you take the levels, once you have them on your chart, you want to, on TradingView, you want to create a, I don't know what they'd call that. Let me do this real quick. Whatever this is called up here, layouts, okay? You want to create a layout that has a title that maybe it's new week opening gaps. And on that layout, the only thing you have referenced for the market that you trade or markets are simply just the new week opening gaps. And or you create a layout that has the only new day opening gaps or new week opening gaps rather that is salient to your market. So that way, if you're ever watching price action, or if you start your new trading session today or tomorrow or tonight, whenever you trade, when you pop up one of your layouts, you'll have the information right away populated on your chart. And you don't have to have all that stuff on your chart when you're working with the chart time frame that you're exercising or executing on. So I'm saying that for the folks that are working, because I'm physically sitting down with you with a laptop. So I don't have all the multiple charts or screens in front. I mean, they're in front of me, but they're off. But I'm trying to teach it from a perspective of using a single device like one laptop. So that way it helps you manage your information and not clutter your chart all up. But once you have them on, this is how you get the other levels that are important to me. You use the low, drag it up to the close, which is the high or new day opening gap. And here is your consequent encroachment. That's the midpoint, okay? That's not equilibrium. It's consequent encroachment. Why is it consequent encroachment and not equilibrium? Because equilibrium is a range that has been delivered up and down. Okay? Think of it like a trading range. This is not a trading range. It's a gap. It's a real gap. So that real gap has a missing level of buying and selling. There's really no buying and selling yet because we stopped trading on the previous session at 5 o'clock and then resumed trading here. So there's nothing being offered as a buy or sell, no printed trades until that opening right there. And then it starts trading. But what is it doing? It's delivering buy side delivery. That means it's going up. So what is it lacking? Sell side delivery. If we take this level here and we add 75 and 25, 0.25, 0.75. What that does, it grades into equal quarters the range. Okay, watch what happens. Look how it stops perfectly right there. What's that price? 18,049.50. It stops exactly right there. Right there. Look at that candles. Look at that candle's low right there. Right up here. Look at that price right there. Okay. What's the low of that candle? Folks, that's fucking perfect. Okay. Perfect. You can't improve on that. You're going to tell me buying and selling pressure stop that right there? Some random bunch of jokers out there looking at goofy stuff. They stop the market right there? Okay. Look how price gravitates around the upper quadrant. See that? See how it's gravitating around that? And it expands just a little bit. Let me take this off because you're probably thinking this has something to do with it doesn't have anything to do with this. Let me take this off. These are extensions for like swing targets and stuff. So the last time we talked, I was showing you yesterday's live session. That's why that was on there. And if you don't believe me, go back and look at the recording and you'll see those levels were actually the ones that were highlighted in my fib. So here we have the upper quadrant, midpoint or consequent encroachment. Consequent encroachment is the midpoint of any gap or any inefficiency. Okay, that means if it's a SIBI, that means it's a down close fair value gap. The midpoint is consequent encroachment. The best shorts will form at the lower half of that because you want to see the upper half left open. A midpoint of a BISI, which is an up close fair value gap, the best fills for going long are going to form in the upper half of that. You want to leave the lower half open. Why? Because you want to see it create a breakaway gap. That inability to fill in that area down there, and if it rallies, that indicates to you that the algorithm is really going to start spooling quickly and you anticipate large range expansions. Holy shit, I'm dropping some diamonds today, aren't I? Yes, I am. Because it's 2024, baby, and it's about time for you to start making some fucking money around here. So this lower quadrant, beautiful. Consolidating. It trades just outside of the new day opening gap. And the market trades down. Look at the sensitivity on the upper quadrant. You see that? See it? Look at that. It's staying very, very close to the upper quadrant. And then boom, we trade down to consequent encroachment. And then one more time, look where it trades. That lower quadrant. Does it one more time just to take the low out, but does it come down and touch the very, very low of the new day opening gap formed at Tuesday, 6 p.m.? No. So what's it doing now? It starts to rally higher. We have this little segment of price action here that is inefficient. There's no trading down there. You know, once it formed this low, it starts moving higher. If you have these levels on your chart, even if this was to come down and touch that low here and then moved out of it, that does not make this high, that midpoint, or that low stale or of no consequence or importance anymore. It's still meaningful to me for 5 days, 5 trading days. Okay, so if this is for Wednesday, this is for your notes. Make sure you write this stuff down now. Since this formed on Tuesday for Wednesday's trading, you have Wednesday's trading, so that's day 1. Thursday's trading, that's day 2. Friday's day 3. Monday is day is trading for day 4, and then Tuesday. So this new day opening gap is still valid until Wednesday next week. That's how I would classify it. Okay, so that way if you have any confusion about how long they're useful to me, or not that they're not useful, but I love the sensitivity around them for the next 5 days. Let's say it that way. I think it's a better way of representing what I really mean. But in truth be told, I will use them 9 months in the past if it's within the narrative I'm expecting to see price behave around them. And that part is experience. So just know that what I'm showing you here is gold, and I'm going to show you how to use it a little bit more specifically because it's my son that's actually the audience member I'm aiming for. So we can see how the market leaves that area. Yeah, there's no algorithm. Here's 7 o'clock, here's 8 o'clock, here's 9 o'clock, and we were way above it. We're really north of it when it formed those opening intervals. So 7, 8, 9. I must have moved that line, I apologize. I was looking at those lines and they're like, they don't look uniform. Yeah, so here's 7, 8, and 9. And we were way above it, so here we are. Oh, there you go. Wow, I was talking in jawbone. It went down and closed it in. Okay, so if you watched it at the very beginning, the recording's still there. I'm going to delete the recording of the first attempt to try to do the live stream, so you'll see this was actually in the chart beforehand. But it's not a big deal. I mean, most of my students already know about new day opening gaps anyway. But the ability to want to see it gravitate back to them every single day, if you have the last 5, like the week you're trading in right now, that's 1 week of it, or 1 day of it rather, and then you go back the last 4 trading days, so you have 5 of them on your chart, and as long as we're in close proximity to them, they're going to be impactful to your trading. And if you're bullish, if there's one above you but there's several of them below you, now this right here, folks, this is gold dust. Okay, if you have a clustering of new day opening gaps predominantly above where the market's trading at, and maybe there's one where you're trading at now around the market, or maybe it's below you, where do you think the market's more likely to go? Oh my goodness. Oh my goodness, I'm getting moist. It's going to gravitate where the multitude of inefficiencies existed, because it's going to give the market an opportunity to go back there again. Why? Because there are people in this industry that trade with this information that you're not supposed to have. And it provides that vehicle of entry, that mechanism of repricing up there. It has absolutely nothing to do with buying and selling pressure. As much as those little goobers that write those books and sell courses tell you, it's not how it works, folks. That's not how it works. And if it breaks your heart, God bless you, get over it, because this is what really makes the markets move around, time and price. But you have to have reference points to know how do these markets book price, because they're going to use these hidden areas. Oh, they're not hidden, ICT. Everybody knows about gaps, right? And look at everybody else's use of them. It's going to be a gap fill, and then it doesn't fill the gap. It runs away. And then the gap's used later on at some other time. And once it fills, they're nobody's interested in it anymore. A la Chris Laurie. He'll say there's an inefficiency, a buy side imbalance, as we call it, buy side imbalance, sell side inefficiency. He'll call that a liquidity void. That's not a void of liquidity. It offered buy side delivery. There was buyers going on in there. What's absent? Sell side delivery. That means moving right back over top of it and tamping over top of that run up in that single candle. So you can look at it. Look at his stuff. Okay, he would say, okay, we're done now. We're done with that. Once it filled it in, he's done. Next setup. Not me, brother. Not me. These things around specific times, they are absolutely useful and will be used by the algorithm. Now think about it. If everybody has the same logic that once a gap fills, it's over, then why would they fucking work again over and over and over again every time you trade back to them? And nobody's ever noticed it? No one's ever noticed it. I got over 2,000 trading books, okay? Not one of these jokers ever talked about it, ever. And the first time I started using this information to call the market in front of family members and friends and say, watch what it's doing right here. Look what it's going to do right here. I don't have the levels drawn on it. I'm just telling them this is where it's going to go. So in other words, I'd have the level here, here, and here just in my mind. So, okay, I know that number. That's the one I'm going to see it trade to. And to watch their jaw open up, like, how do you know that? Yeah, it's good, isn't it? Isn't it good? It's so good. Well, these things are always there. They're never going to hide it from you, folks. Okay? And you're probably thinking, oh, they're going to change it because you taught it. Bullshit. How are they going to change the gap? First of all, they're not going to be able to hide the gap from you. If we open at 6 o'clock higher than where we closed at 5 o'clock, we have a gap opening. It's a higher gap. Okay. I don't care. I don't care if it's an up gap or a down gap. I want to know what those levels are. What are they? The three levels here. Consequent encroachment, which is the midpoint, the highest high and the lowest low. What's the high? Whichever is higher, where we stopped at 5 o'clock or where we opened at 6 o'clock. It's a very simple process. It's not complicated. What's going to be complicated is if you're trying to have 1,000 of these things because it's 200 some trading days in a year, you're going to have a lot of them on your chart. And you're going to look at this and say, what the hell am I supposed to do? And the jokers that are in the listening audience are going to say, well, of course it's going to hit one of these levels. There's so many of them. You're a fucking clown. This logic is very specific. Just look at the last 5. And if there is a clustering, if there's like out of the last 5, say there's 3 of them that are above price at the market price right now. When you are looking at 7 o'clock and 8 o'clock and 9 o'clock, anticipating that engineering of liquidity. I'll come into that. I didn't forget. But if you know that you have a series of new day opening gaps above, chances are they're going to want to gravitate to that. So what would that do for you as a trader? If you're anticipating a short, give it a chance in that first 30 minutes to try to reach in that direction because they might spike it up there in a really thin price run to get up into those old new day opening gaps. Then wait for it to break down and show a market structure or a breaker, okay, and or look for an inversion fair value gap, like I tell you in the part 2 of this mentorship, how to see them. Those are so powerful. They are so powerful. That is one of the bangers as a PD array. If you can sit patiently, I say this about all my PD arrays in case you don't know that, but if you could sit patiently and wait for them to form, they will give you runners that just are so good. It's like the first kiss of a girlfriend. Mm, the taste of those lips. That's exactly what it's like. It's beautiful. It's love. It's love. Love in a candlestick, baby. And this type of stuff repeats over and over and over again. So when I spent time teaching, what I have made a real attempt to do is key your mind up and your attention to these critical times and conditions where the market is more predisposed to behave a manner that's one-sided. That's what you need as a trader. You need movement, number one. You need to be able to predict that movement, and you need to be able to predict the movement's direction. Unless you're trading options, and there's a way to do that too. You don't need to know the direction. You can be delta neutral, but that's another time for another subject matter. But in this case, we can see that these things tend to repeat. They tend to repeat every single day, every single week. Okay. So now, what's the difference between a new week opening gap and a new day opening gap? Well, there's 5 new day opening gaps in the course of a week. You only have 1 new week opening gap. So, what do you think has more impact on a swing trade? A new day opening gap or a new week opening gap? A new week opening gap, because you're factoring the imbalance and inefficiency of a new week opening on Sunday at 6 p.m., where they've had a whole weekend to digest everything, and they use that opening price. Who's that? Those individuals that are in control of the marketplace. I know you don't like to hear that, and I know it pisses you off because I talk in a very condescending tone and arrogant, pricky, and all that other bullshit. But if you took the time to investigate in things that I'm telling you, you'll see that it's there. This isn't retail buying and selling pressure. It's not large funds buying and selling pressure that's causing them to turn, because that's not what happens. Doesn't matter. How much buying and selling pressure has absolutely no bearing on it. You'll be able to sit down and predict with a high degree of precision and accuracy where the market's going to gravitate to. That's the very first stage in your development. That is not profitable trading. That is not precision entries. That's not tight stop losses and low risk management. It is the first stage. And you have to warm up to that idea of knowing, okay, this guy's talking to me. He does talk a lot, but the shit he's saying and the stuff he's pointing out is happening all the time. So it's worth me listening to, because I'm not talking for the sake of talking. I'm telling you all the things that's going to arise in your mind as a fear, as a uncertainty, as a doubt. These are all things I have experienced myself, and I have millions of students. And they all give me feedback, whether I give a response back to them or not. I take that feedback and I say, okay, I can use this information, and the next time I talk about it, I'll kind of draw that into the conversation. So I know pretty much what questions you have in mind. That's why it feels like I'm reading your mind when I'm talking about certain things. So if I'm watching price action and I'm saying I'm looking for this or that, and then I'll say, and you probably think this, 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 because I have heard all those questions before. That's all it is. I'm not clairvoyant. I don't believe in ESP. So as much as it looks like sometimes I have it, if we have a clustering of new week opening gaps below the marketplace, okay, I'm going to elect to see price try to gravitate to that. That's not a hard and fast, only going short. It just means that if I'm going to look for a long, I'm going to wait and see right away, do they want to drop it down there in that direction? It doesn't mean they have to trade to those group of new week opening gaps or new day opening gaps, either or. It's a filter that my mentorship students don't even know anything about. They're grinning right now because they're learning just like you are. And when you have these things recorded in a layout for your chart, you'll be able to see, oh yeah, there's a number of new day opening gaps and a couple new week opening gaps that are below price. And if you've seen, we've only worked it one time. In other words, like we've seen it here, it went down into this one. This is the first time we passed down into it. And this is the second time we passed down into it. Okay. If we've only touched the new week opening gap or a series of new day opening gaps once, they're really sensitive, like they're hot. They're going to be they're going to see price draw back to them. That's just a guarantee it's going to happen. And there's very few guarantees in price. There's very few guarantees in trading. But this is something that you're going to study, and you're going to see it. What I just said is the gospel. It absolutely is always there. And that right there cancels out the whole idea that these markets aren't rigged, because why would it care? Why would it care about a gap that filled weeks ago? Why would it do that? Unless it's being called as a reference point through coding, and it's referring back to a certain span of time. Almost slipped. Let me slow down. It's a very specific reference of time that the algorithm will seek and look back to. Okay. And by having that look back period and looking at these reference points in price, so you have time and then price. And when you can identify these things, and they're never going to be able to hide where they opened the price up in relationship and in deference to where we closed it at 5 o'clock. Can you understand that much? If you're brand new and you're thinking, okay, this is probably going to stop working because it's being taught. I taught this, and it still works beautifully. It's not going to stop working. Okay, believe me, if I believed any of this stuff was going to stop working, if I taught any of it, you would never know about it. Okay, the things that I teach, they're just very market generic. They're going to behave this way all the time because this is the source code. This is exactly what it's going to do. It's always going to do these things until they tear the markets down entirely. This is what's going to be there. So as long as we can trade markets, these advantages are going to be available to you. And that should excite you. It should give you passion and desire to spend more time seeking them and understanding the characteristics around them. And what this does, it gives you a magnetized reference point. of where bias can draw to, even before relative equal highs or lows form. Wait a minute, slow this down. Slow your roll, ICT. Say that one more time, because I think I just heard you say you can predict relative equal highs and lows before they form. Yeah, you're fucking right. Yep, that's exactly what engineering liquidity is. That's exactly what it is. Okay, so if you have a predisposed um, likelihood, if it's likely that we're going to draw down to a new day opening gap, or we're going to draw down to a cluster of new day opening gaps that haven't been traded to or used much, or a new week opening gaps that are clustering below market price. At what time? At what time, ICT? At 7, 8, or 9. You're referencing. You're trying to get a feel for what is it likely to do? Sure, there's going to be volatility. Sure, there's going to be probably all kinds of movement around. But what was the market showing us right away? Well, it's got relative equal highs, but it's also got relative equal lows from 7 o'clock at 8 o'clock. Okay, so if we know the new day opening gap is down here south of all that, down here, we know that it's probably going to run these highs. So you as a trader, Caleb, you're going to be thinking, all right, I know that this is a gravitational pull on price. The algorithm is going to want to revisit this. Okay. If I notice that there's relative equal highs after 7 o'clock, that was the rules I gave you. There's no guidance from ICT, by the way. There's no guidance. There's no rule-based idea. He never tells you how to do it. It's just he talks vaguely and he reinvents things and renames stuff that other people wrote about. Here's the high and the second one. Okay. And the market drops down. Do you chase that? No. Uh-uh. Why? Because you have a new day opening gap down here that it's most likely going to trade to. Okay. It doesn't need to trade there today, as I'm going to prove to you in a little bit. Okay. You can be profitable without it never reaching that. It could do that return back into here in London like tonight. It could trade there in London tonight if it hadn't dropped down there. And that's what I would have done looking for a trade in London. Okay. I know some of you are thinking, oh, here, I would have, could have. Trust me, you're about to see an execution. Just sit your ass down. These highs here, that would be an ideal scenario to run those highs out. That would be a fake move. So that would be a Judas swing, okay, as we referred to before. If we have a predisposed direction in mind where we want to trade, where there's a larger draw or gravitational pull on price that's outside the parameters of just relative equal highs or relative equal lows, because that's just one piece of it. That's just a piece of it. So you want to have a tool, a weapon, okay, a weapon in your arsenal that will help you understand with more probability, more odds in your favor that the market's going to gravitate to a very specific range in price action. And that range needs to be a new day opening gap or a new week opening gap, Caleb. That's your black hole, if you will. It's going to draw price to it. It doesn't mean it's going to be a straight line to it. It just means that it's going to have an overwhelming impact on the overall direction of what price is going to do. There may be static price action moving around. It might have a little bit of flurry of rallies here and there, but ultimately it's going to bend a knee and go right to where it needs to go, which is the new day opening gap or new week opening gap. Okay, so this is engineering liquidity. As the market drops down, we would never go short right away after seeing new start of a new AM session at 7 o'clock and they have relative equal highs, especially if we're thinking a new day opening gap is a draw. So what we would rather do is we would rather see it trade up and cancel out this liquidity. So as it's dropping, traders are going to chase that and think, yeah, this is really good. This is easy. All I got to do is follow the moving averages. Okay. Do your stochastics overbought and oversold. You take your profit and wait for another overbought and go short, right? Well, this level you would have on your chart and you would observe that, okay? Above this high is buy side, okay? Buy side liquidity or buy stops. The market rallies after 9 o'clock. we get this little squiggly line here, and then it runs, pumps up above it. 1, 2, 3, relative equal high, then breaks down, and then creates another relative equal high. Are we more likely to clear these highs here if we have what I've been teaching you here? The larger draw, the more influential draw on liquidity are new day opening gaps and new week opening gaps. That's the real hidden, that's the magnet on price, okay? And when you start mapping them out on your chart and keeping them active on your chart with the time reference points that I've told you, like the life cycle of them, for the sake of having more time used with them, you can create an additional layout on TradingView where you keep them for as long as you want, okay? But just understand, knowing how to use them and managing them when they're older, just you have to keep track of how many times they've been referred to. And it takes a little bit of effort, and most people don't want to listen to me teach something that's going to make them millions of dollars if they put their asses to work with it. But hey, everybody wants to do their own thing. You can see the power of using this information once you start logging them in your own charts. You're going to see them in your charts once you have them. You're going to watch price do all kinds of silly shit that people on YouTube, on Twitter, on social media, if they're making their opinions vocal in public, you're going to start smiling. The corners of your mouth are going to start aching because you're going to be smiling, grinning your ass off because you can see them falling victim. They're literally falling on the sword of the market, and then they're going to get sucked into emotion going right down to these levels or up to these levels in deference to when it's bullish. But you're going to see it, and you're going to watch it unfold, and you're going to have a perception over price that you've never imagined before. It literally is. If you remember watching Batman when he linked everybody's cell phones together, and it was like a radar. He could see things because of their cell phones all being linked together, or like the Matrix when Neo finally saw the Matrix for what it was, and he could just see it in binary code, zeros and ones, and it's very, very close to that feeling, if I can use an analogy that's artistic, if you will, because you have a vision that's outside the candlesticks. You don't see the candlesticks anymore for just open, high, low, and close. You're seeing them as a black hole pulling price, okay? Pulling price, dark pool, pulling price, where everybody else is unaware. They're unaware. They have no idea what the fuck's going on. They're freaking out because they're losing their trade. They're blowing their accounts. Their system stuff ain't working. The guy they're following signals are shit. They have no idea what's going on, but it's careening towards this hidden area that nobody seems to give a shit about. But they saw it when it gapped open at the beginning of the day. They saw it gap open on Sunday. Everybody knows about that gap. It's always been talked about. Gaps. Oh, everybody knows about a gap. Nobody knows about a gap, but they all know about it now. These areas of price will never, ever, 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 ever be hidden from you. So therefore, they will always have effectiveness in your trading. They'll always be efficient compartments to a trading model that has a huge impact on what makes you successful in reading price. Therefore, as a default, if you can do entries that are very systematic, that has sound logic behind them, and you have small risk and you don't overtrade, then by default, what does that mean? That you're offered and afforded potential profitability. And what happens if you do these things, these routines, these protocols, these step by step by step by step things, this guidance, and you don't deviate from it? You don't try to reinvent the wheel. Yeah, I like ICT's rims, but I'm going to spray paint them my color and call it my thing. No, don't change it. Stick to the things that I'm showing you. Don't embellish upon them. Just take that information and use it and be thankful that you got it. Because I didn't have to give it to you. I didn't have to teach this stuff to you. I've been sitting on this stuff for 3 decades, man. Watching everybody else out there act like they know what they're talking about. Everybody on CNBC, the market's going to do this, the market's going to do that. Oh, shit. And then what you'll see is when you can watch social media as a herd, when they start talking about when they're bullish or when they're bearish, or they say, oh, it's a crash, the market's crashing. You'll be able to walk right in there and say, okay, I'm going to be a buyer. Oh, the market's going to drop. It's gonna crash. It's gonna crash. You go in there because you see that herd mentality going against an idea based on these principles. And if it's diametrically opposed, the odds, my experience, the odds are going to be in your favor and less in theirs. And that's the key to trading with high degree of precision. You have smart money, precision, and odds in your favor when you're waiting for periods of time when the market's participants that are stupid, dumb street money, that's people that talk about their ideas online. Those individuals that openly show their hand and show their cards, that is street money. Okay? Street money is my wife when Bitcoin was just about to get to 20,000 the first time, but failed. And she said, do you trade Bitcoin? I said, what did you just say to me? I said, do you trade Bitcoin? And I was like, that's it. Didn't even answer. I went right on Twitter. I said, that's it. Bitcoin ain't hitting 20,000. It's going to go. It's going to drop to 6,000. And it did. And I said I was going to go to 3,000, but I was off by 300 points. It's all history. It's all there. Her perspective is street money. It's the dumb money perspective because she doesn't know how to trade. She doesn't know how the markets operate. And here she is, she has an interest in Bitcoin because it had been going up. Everybody's talking about it. Well, there you go. You're near the high. So what I like to do, and a lot of people get pissed off at me. A lot of people that are taking my stuff and trying to run mentorships and stuff, they're really going to heat up and start talking about me. Okay, they're going to say I'm a fraud. They're going to say this, that, and other thing because they need their marketing to focus the attention on themselves, and they look like a hero because now they can point the finger back. Look at ICT. ICT doesn't teach you. Look at everybody's making money off the stuff I've taught. Don't forget that. Don't forget these people talking to you have made money off of the stuff I've taught. They all have a little sales pitch, and that's fine. Look, I got no problem. I got no personal beef with anybody. You're going to do what you're going to do because you need to eat, and I'm not trying to starve anybody. I'm not trying to starve anybody because what's about to happen, it's going to affect every single one of us. So if this helps me from doling out money to my son because he can now make his money doing this outside and above his job, guess what that helps me do? It helps me sleep at night. It takes any worry about him not being able to make it if something happens to me. He's able to do this. He can take care of it. And that means that his brothers who don't trade, they can learn from him. I've been trying to get one of them to do it really well. So that way I know if I have to lay my head down for the last time and leave this world, that I know I'm able to have this passed on. That's my motivation. But you have to think about, okay, well, here's relative equal highs. So they're going to run above that, right? Because ICT said they're going to run above the highs. You see what I'm showing you here today? This is underlying narrative. And you're coupling it with the engineering of liquidity. If there's an arm wrestling match, okay, say you have an arm wrestling match between, oh, good gracious, I can't even think of anybody that's a strong man. I don't know. Just think of someone that's very, very strong, okay? Big biceps, big upper body, big latissimus dorsi, deltoids, real big. And then you have somebody, some teenager right out of school, okay, and he's got like spaghetti arms, and they're gonna have an arm wrestling match. Who's gonna win? Clearly, right? Clearly, it's gonna be the behemoth. It's a monster, right? Clearly outweighing in strength and everything. When you place the effects of what street money will see in price versus what a smart money perspective is over price, you literally are arm wrestling the strongest man in the world, expecting to win. It's not going to happen. And this repeats every single week and every single trading day because the retail crowd, number one, they don't even believe, most of you listening to me, you probably don't really believe there's an algorithm, but you entertain me because you think this is something like a nervous tick I got to keep talking about or whatever. At this point, if you don't see it or believe it, there's no hope for you. There's literally no hope for you in that regard. You don't need to believe in an algorithm for it to be profitable. You could say, well, I'm going to suspend my belief about it, and it's not important to me. I just want to trade something that works. Okay, wonderful. But you can't knock me for telling you what's really going on, because I'm not lying to you about it. It's really there. And these are the reasons why it repeats. Because if it's an algorithm, the algorithm does the same things all the time because it's following a code. It's following the syntax and coding and the logic that was used to create it. And it has to refer back to old information. It can't pull stuff out of its ass. It's not a real thing. So it has to use instructions like a recipe. Okay, if you have a recipe card, you pull it out and say, okay, I want to make chicken Alfredo. All right, what ingredients do I need? I need this, 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 this. So the recipe is calling your attention to, well, before we begin, you have to have a measuring cup of this much Parmesan cheese and this much of this and cream and whatnot. You have to have all these information laid out in front of you, how much we have to have. But then you have to do what? You have to execute on that and get those ingredients measured out, and then you combine them. Well, the algorithm has to have that information to cull from. It needs to go back in time where it has delivered price before, and it's based on date, day of week, month of the year, week of the month, what quarter of the year, and what price and what time it was trading there. That's the real fucking nitty gritty, baby. That's what's going on. It's going back to those reference points. It is absolutely has nothing to do with how many times a level was traded to and now it's created resistance. Because everybody stopped buying it because it went there before. This didn't stop going up because it ran out of buyers. This didn't go down and not go higher because it was more sellers. But that's the bullshit that you're told. There's a lot of talking heads that get paid a lot of money going around the world teaching that nonsense. There's a lot of people that go on TV and talk about this stuff and say that that's what's going on. And people eat it up. Eat it up. Oh, yeah, that's exactly what's going on. That is absolutely not what's going on. That's not what's going on. The liquidity above these highs, it's traded to here. And then it runs a little bit higher and a little bit higher. And it creates a relative equal high here. And this is designed in engineering liquidity. And this is the part that where if you're anticipating a breakout move, you don't get filled. But if you're short, you're getting punished all day long because they don't want you a part of the move. You have to wait. Wait a minute, what do you got to wait for, ICT? What did I mention at the beginning of this lecture today? The economic calendar, when there's an absence, oh yeah, that's right, you did say that shit. There's an absence of any medium or high impact news driver in the morning session, where they're predominantly usually released around 8:30, sometimes 10 o'clock hour, like that you have the 10:30, you have the crude oil inventory number. That is generally that morning time of day is where all the reports come out, and predominantly it's mostly given at the 8:30 Eastern time. But we had none of that today. But at 1 o'clock Eastern time, we had the bond auction. So in my mind, what I like to do is I like to sit still and wait for them to get everything all set up for that bond auction to release at 1 o'clock. Now, you can look at the economic calendar, and you can use what I'm showing you here today. Every single time they do a bond auction, if there's a day where there's no morning data, this is important now, because sometimes you'll have a bond auction, but there'll be morning news drivers. That doesn't hold true for this. Okay, this is a condition, this is a setup, and a part of determining the narrative where it's just a clean shot, and you can just really anticipate it panning out, and you can trust everything I've taught before in terms of entry mechanisms, fair value gap entries, bearish breakers, or bearish order blocks, and or immediate rebalance. That's some of the things that you're going to see that I used here to do a trade. It was a demo trade. Okay, I want you to understand that. It was a demo trade. It was me showing my son, saying, hey, not Caleb, my youngest son. I said, this is what Dad thinks is going to happen here. I'm going to push the button here, and I'm going to wait for it to come back up again. I'm going to show you the execution. I'll walk you through it, and then show you how, if you want to hold on to a trade, because I saw a lot of people leave in the very first lecture that I started in this 2024 mentorship. I got a lot of comments saying, can you please talk about how to hold on to a trade? How can you hold on to a trade? How to hold on to a trade for a longer price move? Well, you obviously have to be able to get into a profitable trade to begin with. So that right there is the first important factor that you have to first meet. If you can't do that, then it doesn't matter how far you want to hold on to a trade, because if you can't get into a trade and make 5 handles in the S&P or 10 handles in the NASDAQ and consistently be able to do that, you probably are not going to be equipped to try to hold for something higher than that. So I'm sure there's a lot of folks out there that think that by saying, here's how you hold for a larger trade, but they can't do a 5 handle trade consistently in an S&P or 10 handle run in the NASDAQ. If they're not doing that, they think that the answer to giving them a longer trade hold time or a protocol or procedure that allows or affords for that, that somehow answers the question of, I don't need to do a 10 handle or a 5 handle because I'm now going to trade 50 handles on NASDAQ. Okay. Intermediate term price run for me is 50 handles or more. Okay. For NASDAQ. And then you have a larger price swing is 100 handles or more. And I don't have any grading beyond that. But anything less than 50 handles is just, to me, it's like a scalp. It's a very small scalp. Intraday trades, or where you're swing trading intraday volatility, it's usually like a 50 handle or more price run. Okay. And I'm going to teach you a little bit how to do that, and then we'll close it for today. So, what this does is it engineers liquidity with the relative equal highs when the real narrative is it's going to drop down here. And if that's the case, and you don't know how to hold for the longer term trades, because the things I'm giving you here today, it's going to take time for you to grow into that. Okay, it's going to take time for you to get comfortable with it, to fail with it sometimes, and then wrestle with what that failure feels like for you emotionally and psychologically. And you'll see that you're going to do it wrong in the early stages a lot. And every single time you do it wrong, you have to treat those opportunities as an opportunity for you to go in and say, okay, what didn't I do correctly? And what can I take away from this? Don't look at it as, it didn't work, I'm throwing it away, and I'm going to go back to somebody else on there that has some kind of push a button and show me something on my chart, and I'm going to follow that. Or let me follow a live streamer and try to copy them. For anybody out there that's trying to copy a live streamer or a signal service guy or gal, to me, that's the epitome of weakness. Because what you're saying is I am too fucking lazy to learn how to do this on my own. And I'm going to trust somebody else that doesn't give two shits about me or my money or my welfare with my family, nothing. And they're up there for clicks and giggles and ad revenue or monthly revenue from their signal service or mentorship. That's what they care about. That's what they care about. They don't care if you make money. They don't give a shit. But you're going to put your faith in something like that. You're exercising more faith in somebody that does not give two shits about you versus someone that's doing this for free. And I've made millionaires. I've made millionaires teaching this stuff to them, and they're using it. They've brought receipts forward. It's all over the internet. People are using all this stuff, okay? But you don't want to trust me for whatever reason. I don't know why, but this stuff works, and it can work in your hands. And place that faith that you're putting in these jokers out there that are trying to rip your ass off and take money from you. Take that same measure of faith and place it in yourself and your ability to do this, because you can do it. You absolutely can do it. You just got to let yourself get to that point where you're not letting outside influences mess you up. And don't let that internal voice that you use to defeat yourself with, don't let that hold you down either. You're going to have adversities. You're going to mess it up. You're not going to follow the rules. You're going to try to invent something new. And that way you can say, I want to use this and it helped me make my own model. No, you didn't. You gambled and did something outside the realm of the procedures and processes I've outlined. And then it may have worked for you there. Let's see if it works for 3 years in a row and you can quit your job on it. Are you willing to bet it that much before you start talking about what you did on social media? Chances are no. But you want to have some dopamine hit. Your dopamine hit should come by you following the rules and sticking your ass in front of these charts every single day and following the rules of engagement. That means process, practice, proficiency. In that order. That's how it happens. There's no circumvention or navigation around to get to the top of I can now do it because I did it in a shorter time period. Take the time element of how fast you need to get there out of it because you don't know how long it's going to take you. You might be worrying about it. You might be watching these things thinking, I don't know if I can do all this. I don't think I can follow the rules. Okay. Then you have to really sit yourself down and say, is it ever going to get easier if you don't at least try to adhere to the rules? Because it's never going to get easier if you don't do that. But if you do it, even if you fail initially the first few weeks and find no value in it right away, you're working towards a baseline. And by journaling that experience, what you'll see over a month, at the end of the month, and you start looking back at the charts and you say, man, I had no idea what this guy was talking about, but now I see this shit's working. I can't get into the trade yet, but I can see where price is going. And when people get like that, that's one of the best feelings as a teacher because you're learning the hardest parts of this. That's the hardest part, folks. You think it's the entries and where your stop loss is. That's easy shit. That's easy stuff. I got 81 ways to get into that thing. And you only need one. And every single day, every one of my PD arrays are there. On one time frame or another, every 81 of them. There can't be 81. Kimmel, come on. There's 81 of them. And it's not just me talking about an inversion level and calling it one. It's not the inversion aspect of it is not there. We're talking. It's technically what? Double that if you use it as an inversion. But it's 81 very specific PD arrays that I can see in price and anticipate them being there and then key off of that. But you only need one. Just one. Just one. And the patience to wait for it with a narrative expecting price to draw to that. And if you can anticipate that, you don't need moving averages, you don't need trend lines, you don't need trend analysis. There's no trend analysis in this. I didn't even refer to a daily chart. Notice that we're not even using daily charts. We're just using intraday volatility, time of day, time and price, liquidity. But the aspect of narrative, why price should be moving anyway. Why should it move? Why should it? That stems from the economic calendar or the lack thereof. Like we had nothing on the morning session. There was no data. So that's why I scheduled my eye appointment this morning. I told you I can't be with you because I have an eye appointment. I didn't tell you it was an eye appointment, but I got my eyes checked, and my prescription went up two more steps higher. So that's a little concerning. But long story short, I afforded myself the time away from the charts, not worrying about any of this, knowing that the afternoon has that bond auction. Some of my students knew right away by me saying, I'm going to do the afternoon. And I told you around 1:30 yesterday in part 2, I told you I would start the live stream. And then I settled in at 1:45, give myself some time to grab something to eat, whatnot. And then here I am. That is maturity. That's patience. That's knowing what to wait for and what to look for. And also canceling out an interest where everybody else is going to try to break their ass doing something in the morning session. If you have no data, no reason for them to manipulate price in the morning session, okay, write this stuff down. If there's no data, medium impact or high impact in the morning session, try to trade the afternoon session because the cleaner price action will be after New York lunch. When does that happen? As early as 1:30, but starting between 1:30 and 2:30, there's usually some kind of a sweet spot that forms in price action where it's just really, really easy to see it. And even if you miss it, you can start using what I taught you yesterday, where you can use a very sub 1 minute chart and get in sync with the price run that's already unfolding on a higher time frame 1 minute or 5 minute chart. Okay. So to answer the question, and if you'll afford me the ability to go forward with the lectures as I intended to do them for my son. I just wanted to address the question of how to hold on to a trade longer, how to hold on to trades that are moving in your favor longer. I had a lot. I don't know what instigated it, but the very first video had a lot of that in it by lots of different YouTube channel commenters. Like they were really interested in seeing how to hold on to trades longer. And truth be told, and I hope um, Matt doesn't get upset. I can't imagine why he would be upset about it. But at the time when I was talking to him privately in text messages, I was sharing with him what I thought the level was going to be for the day, and then I would execute and trade. And I would show him my entry, my stop, and as it was progressing to the trade, and when it would hit the limit order, or stop me out before getting to the ultimate target, whatever. I was trying to encourage him to hold on to a little bit larger price run. I understand he has a model. I told him, I said, keep doing that, but try to grow in using some of the things I'm going to show you. And I told him the very first um, videos I do, and that's not these videos, by the way, Matt. Um, I was going to do 3 lectures: turtle soup, um, and 2 other ones. I can't remember the title off the top of my head, but two different subject matters. But one was turtle soup and how to hold on to these trades and how to capitalize on bigger runs in price action and not just do ultra small scalping. And he seemed very receptive to it. And he witnessed me doing it like week after week, daily, showing him this is where it's going to go, and it would go there. And I'm hoping that he uses this if he watch. I don't know if he's watching this stuff, but um, the the idea of getting into a trade and holding on to it, you have to have something that's going to have a larger downrange objective, which means you can't look at something just on a 1 minute chart and assume that, okay, you know, this is what I'm going to aim. I'm going to aim for this. You have to have some kind of reason to justify the trade moving beyond what a small time frame like 1 minute is going to afford you in terms of range. How far can it move? And how far can it move that session, but still maybe continue the next trading day or going into the next week? Okay. So just know that I'm going to give you some ideas here, but it's not going to answer everything because it's a subject matter that can be really taken to extreme and just keep building, adding clay to it as you go. Because what does that mean? To ask how long or how to hold a trade longer, because you can use any of these entry models on a smaller time frame, and let's say you're doing it on a day when it's potentially creating a run that may drop for months. See how hard it is to answer that question? So I know how I could engage that, but I also know that my personality doesn't afford me the comfort of sitting in something that long because I see thousands of setups over the span of 1 month, and my opinion can change because I have a very, very hyperactive mindset. So when I look at price, I can see in 1 hour, I can see half a dozen trades that may go unnoticed by most people. It doesn't mean they're 50 handle runs, but I could be buying and selling up and down inside that 1 hour time frame and be done and never do anything else for the rest of the day, or elect to trade on one time frame, waiting for a specific setup to unfold. So I appreciate and understand the question that the students that are asking that, how to hold on to it. So to answer it in a generic way, to kind of like be a blanket response, before you put on the trade, you have to have an understanding of where it could potentially trade to. Okay. And I'm assuming that maybe you're aiming for something like 100 handles or more, something like that. That to me is a fair assumption on the part of holding for a longer trade, because most of my stuff teaches around 20 pips, 25 handles, 50 handles, something to that effect. But anything greater than 100 handles on index trading, or I guess maybe even Forex if you're still trading it, I think that they're respectable hauls in terms of points or ticks or what have you. If you're looking for that type of trade, then you have to use your analysis that affords you that type of range. and I've said it before when I was teaching in other lectures and other lessons on this YouTube channel and in Twitter spaces when I was doing them. The trade has to give me, for instance, if I want to take 10 handles and I feel confident that I can get 10 handles out of the next price run, I got to look for something that's going to give me 15 to 20. Well, how do I determine that? Well, let's give this an example here. If this range is going to be anticipated that it's going to be sloppy in the morning, to don't trust anything in the morning and wait for the afternoon session. So what does that mean? I have to wait until at least 1:30. So at 1:30, that starts the afternoon session for me. Now, sometimes the moves can begin just a little bit before 1:30, and it's not a big deal. I don't care about that. But generally, I like to be in front of my charts at 1:30 because even if nothing forms in that next 30 minutes going into 2 o'clock, I know I can get something post 2 o'clock because there's a silver bullet at 2 o'clock going in from 2 o'clock to 3. And if I miss that, or it just doesn't, if I don't get a good read on it, or just simply doesn't do anything but goes sideways, then I'm going to look at it in the 3 o'clock hour to the close. And every single day it's there, but you have to look at it on time frames that will allow you to see it. And if we're going to use the dynamic that was in play for today, obviously morning session, avoid it. There's no news. And the only information that was going to be used as manipulation or to upset or to engineer sentiment for traders is that 1 o'clock hour when they had the bond auction. So the bond auction at 1 o'clock, that was my go-to. So I was watching and anticipating, okay, there's going to be a move. So I want to see something that is going to be used as a fuel. It's going to be fuel for a run into this down here. But keeping in mind that I'm teaching you, as I taught yesterday, if you're going to trade outside of just a relative equal low, if you're bearish, then you can, for people that have a better understanding, and that's not going to be all of you that are watching this, it's going to be students that have been with me for a while. You got to refer to what the market had done in the previous session, in the London session, for instance. Well, we have this low here, and we have this low here. What does that make that? What is this right here? Relative equal low. Does it meet the criteria I gave you as a filter? The most right side, in other words, there's going to be 2 swing highs or 2 swing lows, regardless if it's relative equal high or relative equal low. The right one, whatever the one is on the right-hand side, if it's relative equal lows, it has to be higher than the previous low. Does it do that here? Yes. So the condition is there that this is a high probability relative equal low for the purpose of drawing to it. Now here's a huge paradigm shift for you, okay? You're going to jump light years ahead in your understanding. The fact that we had the new day opening gap below that, that is a further like rocket fuel that this is going to be easy to trade to. But in the beginning stages, you won't know these types of things and you won't have the confidence to hold on to it. So you graduate into doing it by taking trades just to aim for this, and then you paper trade, or not, I shouldn't say it like that. Paper trade, like if I say paper trade, you're going to say, okay, so in other words, demo trade it. No. Yes, you can demo trade it or tape read it. So in other words, if you're going to get to the point where you trust it, but you can't hold for a move down here because you just can't find it in yourself to do that because you're watching the profit grow and grow and grow, and it's probably the biggest trade you ever had in your life. And now you have anxiety because you're afraid that if you don't take the trade off while it's at the biggest point of profit since you put the trade on, what happens if it reverses? And you're going to feel bad that you didn't take out the full 1,000 or hundreds or whatever the size is that you're trading with, then leverage and affording you that profit. You're going to be worrying about that instead of watching and seeing, is price still behaving in a manner that supports the idea of it reaching to this level? Okay, so number one, to hold on to trades longer, you have to have something outside of the normal range that you would trade for. So if you're graduating from 25, 30, 50 handles, there has to be something that points to price going to something beyond that. Okay, so if we're looking at that lunch hour and we know that there's news coming out at 1 o'clock because of the bond auction, me, I'm a little bit more, I don't mind risk. Let's say it that way. Okay. If I do something wrong, I can go back in and generally fix that problem. Okay. I can like mitigate that. Or when I was doing dominoes, I used to manage the dominoes when I was younger. Um, we had a running joke for any new hire that came in. If I was running out of dough, I would usually take the last dough and put my hole through it before I slapped it out into a pizza. And I would show the new hire and say, look, go into the freezer and bring me the dough repair kit. And it's a running joke. Everybody that works there knows it's bullshit. There's no such thing as a dough repair kit. But they'll look at you, nod, and they'll go into the freezer and look around for something that says dough repair kit. There's no dough repair kit. So I say that because you have to treat your boo-boos in trading just like that. If you make a hole in the dough when you slap it on a pizza, just flatten it out, roll it out, and it's fixed. Pinch it, roll it out, and it's done. In trading, when you have a loss, or if you did a poor placement, you took the trade a little too quick. You were trying to anticipate the setup versus waiting for the setup, and you may have to get out of it and wait for the real setup to form. And you may get a drawdown. You may get stopped out, and you may need to do something else, as a later setup. Well, the mindset that's needed to do that has to be in play also, because if you're going to be holding for longer term price runs, the potential for you to be stopped out prematurely increases exponentially, because in the beginning you don't trust that the market's going to still work towards this direction. Every little retracement is going to feel like it's bottomed because you don't have that experience yet. And when you start having these new day opening gaps and new week opening gaps and start waiting for price to gravitate towards them, that is like an exercise that strengthens your patience. But you can't fast track it. You can't make it happen faster because you want it to be faster. Like, you just can't download the experience of saying, okay, I'm just going to hold for these new week opening gaps or new day opening gaps, and I can trust it because ICT said so. So that's enough. No, you need to see it for weeks and months, and then over time, oh yeah, I can see what it's trying to do, and I'm not going to get tripped up by all these little fluctuations. But with that said, just know that there's a graduation point that you have to go to, which would be using this area right over here. So that's what I've been teaching you so far in the first two lessons, that we're looking for these types of things when the market is likely to go lower. What are we looking for? Caleb, we're looking for these types of things here. A higher low than the previous one that are in close proximity to one another. So this is a target that we would use to aim for going short at a time when the market is going to be used to accelerate around that bond auction number at 1 o'clock. If you look in here, right here, zoom in a little bit. You can see this is not market replay. All right, here's one of those 81 PD arrays. Okay, the market trades up and starts to roll over. What time of day it's at? It's 12:42. So what are we approaching? We're fastly approaching what? That 1 o'clock hour, and the news is going to be released at 1 minute after 1. Okay, so basically it's 1 o'clock. So 1 o'clock, the bond auction number is going to be released to the marketplace, and then everybody does whatever they're going to do based on that. Okay, so the understanding is this: that number comes out, and then traders are going to buy and sell, and the buying and selling pressure after that market release is done pushes price around. Bullshit. What's actually happening is the market's already starting to run lower. This candle here trades up. I want to see it be sensitive. Let me take this execution off for a second, and I'll put them back on in a moment. I want to be able to show the candles, and this shit's in my way. This candlestick traded up into this gap. Now, if this was a PD array that I wanted to trade on, that would be my entry. But because I'm trading ahead of, no, this is the stuff that you write down, because these are all questions people used to leave on Twitter to me when I was doing Twitter Spaces. These are always in question form in my comment section. My mentorship students have asked me this many times in email, in the place where we meet. All those things, it always comes up. Okay, what do I do if I am not going to trade the fair value gap? What am I looking for ahead of a news drop? Because sometimes you'll see me take a trade before the news or before the opening bell, and I'm recording myself doing it. And invariably, what will happen is how did you know it was doing that? How did you trust that it was going to go that direction? How did you know it wasn't going to go the other direction? And the assholes will say, well, if it went the other way, you never would have showed that. That's their cop out. But I'm going to give you the logic joker so that way you can go start testing it and back test it and see it. And it's exactly what goes on all the time. Okay, so if I know at 1 o'clock, that's when the news is going to hit for the bond auction. Okay, we already rounded over here and we had a fair value gap there. The bodies are respecting it and we started to displace lower. So just with this alone, looking at the chart like that, okay, if it's just looking like that, in your rudimentary understanding of what I'm teaching, you already know the likelihood that it's probably going to explore below that low. Why? Because that's where liquidity is. And it's been going down all day. And this is the time it stopped and came all the way back up here and moved lower. So what is it? Remember what it's gravitating towards? Down there. Okay. But now you have this short-term low here. By itself, that's a reason to be short. You have two factors. You have that new day opening gap as a larger, like black hole, wanting to eventually pull price to it. Then you have this low here where there's very short-term minor sell side liquidity. Okay, so there's sell stops below there. Don't be worried or consumed about the fact that these highs are relatively equal. Don't let that bother you. Why? Because the market's moving lower and it's pulling to this. And even if it doesn't trade there during the day session, because this is the day session low here, during the 7 o'clock to this point, this is the lowest it traded to at that time. So there's going to be stops below that for anyone that try to chase this going higher. These relative equal highs, they can stay in play. They don't need to be upset. They don't need to do anything. The market's going to stay heavy and keep working lower. How do you know that, ICT? Experience. The fact that this is still likely to happen. And think, what's over here in the London session? That low. There. So we have this low, and this. So what is that? That's three things. That's heavy factors on wanting to see price draw to it. There's no entry pattern there. There's no moving average, no indicator, no bullshit logic, except for its liquidity, and the market is operating on a narrative that it's going to drop to reach into that liquidity. Because if they're going to spend all this time above these relative equal highs during the 7 o'clock hour and 8 o'clock hour, and then they Judas swing into the 9 o'clock, well, this is all being held up there, tripping people up, chopping people up, grinding them all up, and then finally it breaks. I don't need to be a part of that, because the economic calendar, just like the TV guy used to do for me, would tell me when my favorite time in front of the box would be. At 9 o'clock on a Friday, Lou Ferrigno would turn green. He's the Incredible Hulk, Channel 11. I know where I'm going to be at. Well, the time on the economic calendar says that at 1 o'clock today, we have a bond auction. That's the only point of interest that I have on the economic calendar, and it's a medium impact driver. It's not high impact, but it's medium impact. So what that means is I want to be in the market anticipating this low being taken out, this low from London with relative equal lows. Remember, that's this over here. See that? That's going to be taken. And this is the part for those that if you are not able to hold the trade longer and you don't know how to get there, this is what you do. You take a partial below here and you close the trade here, and then you tape read the rest of it. And you journal the shit out of it. You journal every single time you feel an impulsive feeling or emotional about the idea that maybe if you think it's going to not go down there, that's when you screenshot it. And real quickly make a notation on it that I have doubts it's going to drop here. And then what you do is you look at that after the fact and say, okay, I didn't see this, so this is the takeaway. And you reinforce it positively. And by doing that exposure, you desensitize yourself to needing to be right. And it expands your comfort from getting into this trade and getting out. Maybe that would be the end of your trade. Or getting into the trade and then getting out below here and never seeing all this run down here. But it gives you that little cookie, that little reward that you did something. It was sound logic, but then you use everything past that time that you close the trade as a real focused oriented drill to build your experience and exposure to waiting for it to pan out. Believe me, it doesn't happen overnight. It's going to take you a long time to hold on to price runs that just go and go and go and go. And honestly, you're going to miss a lot of big runs if you want to trade like that. And if you allow yourself to be beaten up easily, and you'll do it. Trust me, every trader does it. I should have held longer. I wish I would have held on to it more. I wish I wouldn't have took all the partials off. I wish I would have held the whole thing. That's all toxic thinking. So when I answer a question like this, that's why it's very long-winded, because as soon as I mention anything about it, there's a series of new questions that will come up, and it'll feel like I didn't answer the question for you, which is why I opened the whole dialogue around it with, I know me talking about this isn't going to answer or scratch the itch for every one of you, but as a means of growing in the right direction on how to hold on to a trade longer, you do these types of things. And it's already been taught on the mentorship, and it's already on the YouTube channel. It's something I've talked about multiple times. But now, anyway, we're going to go back into this area right here. I got to zoom in on it. All right, so I know that this is the time when the market should start running, because that's when the bond auction numbers come out. Okay, we're up here. I know I have a real strong likelihood it's going to at least take this out and maybe run below here going into that 1 o'clock news release. Well, here's the 1 o'clock, and then the market drops. Here, what I was looking at is I want to see, does it do this? Does it run up into this fair value gap there? That's this here. There's your fair value gap. And what is it doing there? Does it at least touch the consequent encroachment or midpoint of that gap? Look closely. No, it doesn't. It gets real close to it, but it doesn't. Let me see if I can make it a little bit bigger. See? Just falls short of it. The fact that it goes up there and doesn't touch it and then closes here, I know that that right there is a bearish order block. I can trade after the next candles come up and bump into the bottom of it. I'll trade short there. All it has to do is move away from it and then come back up into that. I can trust this candle not being overtaken. What's the next candle do? Goes up to it, but doesn't touch this line, and it doesn't even breach the candle's high. Now, if it would have traded up and touched that midpoint and then did that, I would not have taken that trade. I would have waited for another attempt to get in there and work just a little bit above the consequent encroachment, and then I would try to go short in this upper part there. That's what I would have done differently. But because it didn't and couldn't even touch the consequent encroachment, these are PD arrays. And yes, they're used for very specific and static levels to enter and exit on. But I also use these same price points as a means of measuring strength and weakness. If this candlestick can't even touch that, but gets close to it, it's signaling. It's a signature. That's an algorithmic signature for someone that knows what they're looking for. That tells me that when this candle closes, all I need to do is see it move away and come back up and touch the bottom of that, and that's a bearish order block. Yes. Now, with that logic, I can be short and take a partial below here, or if I know that I can trust that it's going to go down below the London lows, then I'll put a limit order below that. And then I could sit and explain to my son that I think it may go down to those lows, but I'm positioned now that if it doesn't need to do it today, it'll probably go down there in the London session tonight. Where? To the new day opening gap down here. So with all of that narrative explained to you, let's put the executions back on. There you go. So now we have the market displaced below the bearish order block. This candle here, we open and trades up. There you go. It trades up, touches it, goes short. There's your low. What's the low of that candle? Look right here. See that candle's, see that price right there? Right above my cursor. That's the low. What's the low of the candle? 18,320 and a quarter. Okay. The fill, 18,321 and a quarter. So as it's bumping into that, I'm selling short right there. And I want to see it aggressively run below here. It does. Go back for a second. The fact that we traded up here and we didn't touch the consequent encroachment of this, I like to see if there's two fair value gaps, because we have here and we have here. You have to at least anticipate that it may go up into that higher one. But if it fails at the lower one's consequent encroachment and there's a news driver coming, I have no problem, no fear, of absolutely none of getting into the trade. If I did it wrong and I get stopped out, I've shown executions where I've done this. My students have seen it. It's on my YouTube channel. It was on Twitter. You've seen me get stopped out, and then I go right in there and I do another entry and it pans out. Or if I did it wrong and I know that my direction was off and I'm offside, I reversed and did the other direction, and then the partner just goes the other way. That is going to come by experience. So invariably, if I address or field the questions that come to me, a lot of these questions will be answered with your own experience, and it's an unfortunate cop-out sounding response, but that's the truth. You're gonna feel comfortable doing certain things that you aren't going to be comfortable even imagining doing at the beginning of your stages of learning. So I wanted to see this stay open. Okay, I wanted to see it fail to get to that midpoint of the lower one, because it failed there. Okay, wonderful. I'm not worried about it. But go back to what I was saying. If it would have touched the consequent encroachment and this candle, I would have anticipated trading up into the higher part of this. And then my stop loss would have had to be above the midpoint of this consequent encroachment. You see how this gave you everything that is logic based. This is your guidance. These are the things I've already taught. They're in all the discussion points of everything I've ever taught on this YouTube channel. All these things, unless I said my students have never learned that, everything else has already been taught to you. But because you didn't write anything down and you didn't take notes and you're just falling asleep to it, because a lot of people use me as a lullaby and they just listen to me and go to sleep, which is fine. Whatever, I'm glad I can help you sleep good. But everything I've taught, unless I'm saying to you, this is the first time even my students learned it, I'm expecting you to already have it in your journal, in your points of understanding what these things are expected to tell you. But anyway, it drops down, and then we have an immediate rebalance. Okay, so we have the market trading down here. We have a big down closed candle. The market trades back up. Boom, bumps into it here. Immediate rebalance, and then I get a little bit of heat here, but that does not take me underwater. This was only, it would still have like $1,700 in profit even with here. Why? How can that be possible? If I'm entering here, look at down here. If I'm entering short there, why isn't that giving me drawdown in the trade? Negative drawdown, let's say it that way. Because the larger trade entry is here. There's 6 contracts here, and you see me doing this all the time. This is my model: 6 and 4, 6 and 4. So 6 contracts at the higher price if I'm short. The secondary affords me, when I'm only doing 4 contracts, it affords me to trade above that entry. It's forgiving because it could do what? It can revisit this fair value gap. It can trade inside that, but I don't want to see it do that. So I had to have a little bit of heat there, but it doesn't fill it. It just goes up to that level there. And what is it doing there? Is it touching the consequent encroachment before it makes the swing high here? Nope. So that, what does that tell me? It signals to me, just sit back and relax. Don't do anything. Just relax. Move your stop to your first entry, -2 ticks, and just relax. Just relax. And now we go into 1 o'clock. Look what happens at 1 o'clock. They pump it and then dump it. Small little fair value gap right there. All you're doing is you're studying price and you're seeing every SIBI. Remember I was telling you yesterday, when the narrative's in play and it's going to go lower, or your analysis is assuming that it will go lower, you're looking at how the market is treated at every SIBI, sell side imbalance, buy side inefficiency, or a fair value gap that has a down close. It's defined by this candle's low, this candle's high, even this range is that far down. This is the only imbalance. So we have a little bit of an overshoot there. That's called a mohawk. It's just a coloring outside the lines. I talked about it yesterday. It doesn't change anything. It doesn't change it. Did it take out this high? No. All it does is it went outside the boundaries just a little bit, and the next one gives you peace of mind because what is it doing? It's stopping right at the high of the fair value gap. What's the high of that candle? You're going to look right here, upper left-hand corner. Look at that value right there. What's the high of that candle? 18,283.75. What's the low of this candle here? That's right here. 18,283.50. It's not going outside the realm of what you would expect price to reach to and then move away from. Is that proving to you that sellers and their selling pressure had the ability to stop it like that? It doesn't do it to me. You'll never convince me of that. You'll never convince me that sellers and buyers stop every bit of one of these turns in all these PDA arrays right to the tick or the point or within a earshot of it. You're never going to convince me of that. And even if I didn't believe in an algorithm, I would think that it was something other than that. But thankfully, I don't have to. But the market trades aggressively after 1 o'clock, after we have a retracement. So here we have model 2022. Here we have optimal trade entry. Easy, isn't it? It's easy when you have all of the guidance and rules in place. And you do the things that you're taught to do, focusing on the time of day and anticipating the delivery of price based on factors that call price to it. New day opening gaps, new week opening gaps, relative equal highs, relative equal lows. And then below that, in terms of importance, you have inefficiencies. Inefficiencies are subordinate and less important than relative equal highs, relative equal lows, or new day or new week opening gaps because their influence over price. The algorithm will refer and prefer more importance and significance placed around them. I'm not going to tell you the logic behind that. Just trust me on that. It'll serve you well. You don't need to know anything beyond that. When you drive your car, what do? You push the button or turn the key. You don't need to know how all that stuff works under the hood. Same thing here. Gaps, when they're actual, like new week open and new day opening gap, that is absolutely going to be much more significant because there's a lack of trades there. Inefficiencies, I'll say this much. You have one side of the delivery offered to it, meaning that, for instance, let's go back to this one here. This sell side imbalance, buy side inefficiency has sell side delivery. Okay, sell side delivery is always one-sidedness moving lower. Sell side liquidity is what's resting below that low. The London low, or relative equal lows that this line is here, remember that's this over here. That's these over here, okay? That is sell side on the daily range. That's the lowest it's moved for the day overnight, London. So it's going to want to try to gravitate to that too. That is real orders. That's not inefficiency. It's there's real pending orders down there. That is the lifeblood of the marketplace. Real buy stops, real sell stops. That is the heartbeat of what makes these markets go up and down. In between that, okay, in between that, you have inefficiencies. Inefficiencies have one pass through. So they have delivery. In this case, we have sell side delivery, but what is it lacking? Buy side. If I'm bearish, I don't want to see buy side offered because what that's telling me is I don't want to see it trade in the upper half of this. I don't want to see that at all. In fact, I'm enamored when I see it not even touch consequent encroachment. I basically get a hard on from that. I am turned on by that when I'm in a trade. I get so cocky and arrogant. You see it in my trades, or I'll annotate it. I say very facetious things because I see not just this signature, but other things I'm not going to share with you, and then that pisses you off. Oh, you say you're an asshole. You're not teaching me everything. I'm teaching you more than anybody else would, and I'm teaching you how to make lots and lots and lots of success. Therefore, money, bread, dinero, moolah, fun coupons, right? The fact that we don't touch that consequent encroachment or midpoint, man, that tells you what? It's really heavy. Because otherwise, it would be natural for it to come back up in here, trade there, close it in, and it could still roll over. I don't like those kind of trades. That's Chris Laurie stuff. Chris Laurie stuff is let's fill the void. That's not a void. That's a sell side delivery. It's imbalanced. It's only sell side. It's inefficient in its buy side. It's not gonna be balanced if it just trades up there. That's not balanced. Okay? It needs to go there and then leave it. Then it's balanced. That's a balanced price range. So we're not talking about Chris Laurie stuff, and you need to stop leaving those comments in my section. Okay, I made Chris Laurie a millionaire by pushing lots of people to him, and I'm never going to rip him again. I've seen emails where he's talked about me, two-faced out both sides of his mouth. He can kiss my fucking ass. So there's your skinny on Chris Laurie. But the point is this: at 1 o'clock we have an up close candle, and it pumps it. And what's it doing? One candle is moving up. So people that are watching that and they see this go up, even though it's a 1 minute candle, that triggers people that watch 1 minute candles. Hey, I watch ICT stuff. I watch people that trade smart money concepts. We're watching 1 minute charts. 1 minute charts is the bee's knees, baby. You can't make any money unless you're trading a 1 minute chart. When they see this do that, they're like, oh, here we go. It's making a failure swing. It's going to go up. And this is probably going to turn into an inversion fair value gap. And it's probably going to go for those relative equal highs up here. They chase something so minute and insignificant, losing the entire plot that it's going to want to run the London lows. And now, as I taught you today, it's going to try to gravitate to new day opening gaps. And the market does, in fact, trade down below the London lows. And you can see my fill right there. So my limit order is just below that there. So if you look at the fills, 321 and a quarter, adding a partial pyramided entry of 4 more contracts at 291 and a quarter, scaling off the entirety of the position, 10 contracts at 18,213.50. So that is over 100 handles with the largest portion there, and that smokes all your favorite live streamers. Now, your response is going to be, but it's demo. My response is, this is how I teach. If it doesn't work here, it won't work anywhere else. You're not going to spend my money. I'm not going to trade with real money in front of you. I'm going to teach you the logic. I'm going to show you what it's going to do. And I just saw a young man just use the stuff I just taught in his mentorship, Trader Chris. Okay, I left the comment a little smiley face because he used what I taught and he had a trade pan out for him. Immediate feedback, immediate success. What is he doing? He's putting it to task. He's working with the information. If you're going to sit back and just watch things and look for things to criticize and not really try to learn it, you're going to be fucking broke the rest of your life. You're going to be a failed trader. You're going to worship other people on the internet, hoping that they're going to grease your palm and give you something special and easy, and it's never going to happen. How do I know that? Because I spent years and years and years trying to do that. I'm sorry, but I'm the best fucking thing you're going to get in the trading industry. Best fucking thing. I'm going to give you gold for free. I'm going to give it to you and keep giving it to you, and you're going to love me for it. You might curse me, you're going to talk about me behind my back with your circle of friends, but you're going to come back and watch my videos. You're going to learn how to make money, and that's all I care about. I just want to see you do well, because what's about to happen, not just in America, but in every country, we're all going to get the raw stiff right up the backside. And it's going to get real hard and real expensive. And unless you're making more money outside of what you're earning at your job, and you might even lose your job, you're going to feel pain and anxiety and stress like you've never felt before. So this helps me. This helps me feel better about knowing what I know, and I'm not being greedy with it. I'm not being self-centered. I'm not the prick that you think I am. I'm literally giving you things that nobody else on this fucking planet knows. How about that? No one else is going to teach this to you. No one else is going to be able to replicate it. They can't do it. They can't do this, folks. They can have my logo in their fucking thumbnails. They can't do this. They're not the fucking author. They're not the person that created it. They didn't codify it. I am. Period. I'm not going to make it any more plainer than that. If you can't see that, I don't give a shit. Do you want to make more money? Do you want to do the things in this marketplace and that you can constantly trust that these things will be there? Every single trading week, they're going to be there. It's just like having an apple tree in a backyard and it's ripe. All you got to do is walk your ass out there and pluck one off the tree. These setups are there every single day. And the logic behind them, it takes a little bit of time and effort to learn it. That's all. But it takes effort. And millennial mindset, TikTok mentality, the attention span of a fucking gnat, that doesn't get you anywhere. Not in trading, not in life. My own kids tried to do it that way. My own children, my own flesh and blood, want it easy. And I'm saying no. If I'm not going to do it for my own kids, why would you expect me to do it for you? Because it won't work that way. It doesn't work that way. This stuff is available to you. It's on my YouTube channel. I'm never going to delete the channel. I'm never going to delete the videos. I'm never going to charge a private mentorship where I'm charging money. Why are you finding fault with this when it works and other people are making money with it? And I'm continuously teaching it. Why? Because you want to sell your own horseshit. And you got to find some measure of importance by spitting on somebody else. But there ain't never going to be somebody else outshining me here, because I'm making millionaires for fucking free. And you don't have to give me anything back. Top that one. Top that one. Can't. You can't do it. And that makes you mad, because that makes me the fucking hero. And I don't want to be a hero. I'm the anti-guru. I'm doing everything opposite of what a guru would do. I could be making millions of dollars a month all over again, selling. All I got to do is put a PayPal link up. All I got to do is do that, just like that. In one fucking night, I'll have hundreds of thousands of dollars. Before I wake up, there'll be $1 million in that fucking PayPal account. It's just like that. It's literally just like that. But I don't want that. And when I'm done teaching this, unless another one of my boys want to go through this again, I'm not teaching stuff on my YouTube channel. I don't want to make videos. I don't want to do it. I'm just not, I don't feel like I want to do it anymore. But because it's my son and I want him to hear what I'm saying, I need him to have the right mindset. And this is dad talking to him. This is dad chilling his ass out, reminding him that this is not going to be easy. He's going to have to work his ass off. And there's going to be a lot of things that he has to write down and test the theory and see it for himself. And once you see it, you can't unsee it. You can't forget it. It's there. It's ingrained in your idea of how these markets will work, how these markets will book. And when you see it and you know it and you can trust it, nobody can take it from you. They can talk shit about dad all they fucking want. They can do anything they want on the internet. Chit chat, all the bullshit they want to say. They're fucking broke. They're never going to make it in this fucking industry, and they're trying to climb up on my back because it's strong as fuck and I can carry all you fucking haters. That's what they're trying to do, because they're irrelevant and insignificant. And then you have the classification of people that come to this channel and they watch it. They're quiet. They don't even leave comments saying thank you. They're just quiet. They put it to work and they find out for themselves, wow, this shit really works. And then I get my emails and then I get the comments. I've been following you for a year. I never left a comment before. I just passed my funded account. I just got my first payout. Thank you so much. I never thought this was going to happen for me. I have thousands of those every single fucking month. Every single month. From every prop firm and every brokerage firm that's out there. I have students that are doing that. There ain't a motherfucker out there that's teaching people how to trade that has that much reach. And guess who's doing it? Me. Without a price tag. Without a fucking give me some money for it. Who are you going to trust? Who are you going to trust? Somebody that's going to say, here, join my bullshit, pay me money. Or the guy that just simply just does it and makes other people money off of it. I don't get nothing for it. I don't get no kickbacks. I don't have no affiliate links. What's in it for me? Oh, but you make ad revenue. Only until I'm done, and then I'm stopping. That channel was only paying me $30,000 a month. $30,000 a month. Dude, seriously? Get out of here. I was making millions of fucking dollars without even doing anything. Without doing shit. What's $30,000? It's nothing. It's literally nothing. I paid $30,000 just in the last month just for landscaping stuff. Yeah, how about that? You want to have a fucking big house with a big lawn? This shit costs money. $60,000 for two air conditioners and furnaces to be put in upstairs and downstairs in your house. You want to have a big house? It costs money. You think YouTube's going to fucking pay for that? It ain't. It ain't enough. And I just don't have the energy to sit here and put videos out here and videos out here. And I just don't have it. There's too many things going on in the world. And I have to make sure my household and my family are ready. But the only thing that's going to draw my ass back out here to do this is what my son Caleb just asked me to do. Teach him. And I would not be putting videos up here unless he said he wanted to document everything. He liked the idea of the ad revenue helping him along, and he's trying to make a way of doing it. And if he gets that, it carries him through. Guess what that means? He's got a secondary income plus his job that keeps him from doing what? Gambling and pushing the trade when he doesn't have to, which is what most people do when they're trying to learn how to trade with real money. And that's why when you're learning with real money, that's the worst thing to do, because you're going to have all the worst toxic thinking right before you push the button. And that's why it's not good to do that. You see this right here? Right down here? It says demo. See that? Demo. Paper trading. Okay? Paper trading. That's your best fucking friend when you're first learning how to do this, because no one can grade you. No one can ridicule you. And you don't pay taxes on it. You don't have to worry about a realized loss. So what does it give you the freedom to do? To focus on what price is doing. And that's the only thing you need to worry about. But when you try to do everything else that everybody else is teaching you to do, try to combine, try to get a funded account, trade with a little bit of real money, you have so many more things to worry about that are going to distract you versus watching what price is doing. You have to look at it and measure. As prices fluctuate and go up and down, when you're up $500, then you're down $200, and that's normal. Then all of a sudden it starts running and you're up $1,500 in a trade, and that $1,500 is going to feel like you want to get out of it. But is there a reason for you to get out of it, except for you just never made that much money before in a trade? Well, if that's the answer, then you don't close the fucking trade. You hold on to it. What did you put the trade on for? Oh, I got 40 more points, 40 more handles for the trade. That's if we were talking. That's what I'd ask you. Okay, why are you antsy right now? Why are you hyperventilating? Why are you getting up out of your chair, pacing around? Why are you rubbing your arms? Oh, I'm nervous. I'm hyperventilating. I'm scared because I'm afraid it's going to turn into a losing trade. Why? Because you think that this stuff doesn't work because you didn't practice it enough. You didn't see it in demo. You didn't tape read it enough to trust that these things repeat every single week. When I came out with that slogan, every week, every day, and it won't stop, that wasn't just some fucking jingle. That's the reality. Every single week, every single day, and it's never, ever, ever going to stop. As long as these markets are there, you're never going to be short of opportunities to use this information. That should give you a fucking raging hard on. Like, you should be walking around with perpetual Viagra. Like, you should not be worrying about those types of things. But that is the clearest indication that you're brand new or you don't tape read. Because if you do that, those questions never come up. Those concerns never come up. You just don't see it because you haven't looked for it. And because you study and you see it and it's been journaled and you log it, you have experience after experience to lean on and say, you know what? This has been panning out like he said it was going to. And one day it's going to fail in your hands. And you're going to need to see how many times it's worked before. And that's going to be your crutch. That's your counselor. That's your remedy for stress and doubt and fear. Because when you go back and say, yeah, but look at all this. I mean, it did it this day. I thought I was going to do that. And it did it. I looked at this day here. I did this. You got months and years of looking at that and seeing how many times it works. So when it does fail in your hands, you did it wrong. I do it wrong. When I lose, there's nobody's fault in it but mine. It's mine. I did it. I did it wrong. I'm the operator. I messed it up. Guess what that does? It immediately allows you to let that loss go. But if you take that loss and you put it in other people's hands so they can criticize it, guess what that means? Now you made it into a discussion. It's a conversation piece now. You're asking other people that you really don't give two shits about, but you just want them to pat you on the back when you do it right. You're doing everything wrong. You have to filter that stuff out. Even when you're successful, you don't go out there and say, hey, look at all this money I made today. Because you can't believe it just happened to you. If it's in your bank account, trust me, it's fucking real. Go buy something. You don't need to go on the internet and say, this is how much money I made. Here's the proof of it. Here's the proof of the payout. Here's my certificate. Fuck that. That's a little dick energy perspective. That literally is what weak-minded boys do. A man that is understanding what he's doing, a man of principle, does not need to do those things. The fact that he was able to harvest that money, bring it home for his family, and afford himself and his family whatever they need, that's the reward. The peace of mind knowing that that's what you can do again next month. I can do that again next month. I can do that again next month. It ain't going to change. This is the same shit. It's redundant over and over and over again. That's what back testing, that's what tape reading and demoing provides for you. And because you've desensitized yourself from being right or wrong, having to make money. See, you have to make money if you start with a live account. You have to, or you'll have to refund it. You'll have to put more money in it. You're increasing the likelihood and odds of you having to do that if you skip over everything I've talked about so far and what I've already taught many times before. But many of you want to just skip over it like it's somehow going to be easier for you. And you don't realize that the lessons you get in that stage are the very things that carry you through long-term profitable real money trading. What experience do you lean on if you're not having this? Hope and a prayer, emotion, dopamine. Come on. You have nothing to lean on. You're gambling. That's what that is. But when you can look at the marketplace and strip it down to its chrome and say, okay, this is when the market's going to move. When? Well, at 7 o'clock, we can start looking for signatures. It's going to do something. At 8 o'clock, we start looking for signatures and see if it's going to do something. Relative equal highs, relative equal lows. If it forms relative equal lows and you've already determined it's a new day opening gap or a cluster of them, and maybe a new week opening gap, same thing, below the marketplace, wherever it's trading at when we start watching price. Think of it like a kill zone. You have all of these things behind the scene that retail traders have no understanding of. And they're getting their asses handed to them. And without any understanding of why it's happening, they're losing and losing and losing. And you're on the winning side. And you're not worrying about it not working in the future because this is what the markets do. When you go out to your car and you turn the key or push the button, do you expect fucking confetti to fall from the fucking roof? Do you expect that shit to happen? Because I've never expected that to happen. Okay? I expect the car to turn over. And it starts up. Done. That's a reasonable expectation. It's what it's supposed to do. When you look at these markets with this perspective, we're not looking in here thinking, well, ICT said he had 81 of these PD arrays. Which one's hiding from me today? What the hell? Why is he not trying to teach all that? Why are you thinking that? How about looking for the ones I've taught? Because they're there every day. On any given time frame, you're going to find a plethora of everything I've taught. But your task, and I'm saying this and I'm closing because I already went way over. Is it going to be a brief one? I told you. Your task is to study price action by backtesting, journaling old data, and then picking out in hindsight where price did certain things. Okay. The next stage is for you to tape read watching real price action. So Caleb's got to watch nothing live this month. He's got to go through old data and collect it and show me what he sees in price, what it did. And what that will do is it gives him a foundation of identifying baseline price action, what it genuinely and generically will do. The following month, I will expect him to watch price live when we're doing the live streams. And I'm going to point out things before it happens and tell you this is what you're looking for. This is what price should do. We don't want to see price do this. And then we do that for a full 4 weeks. After that, month 3, I will be talking about pushing the button and getting in and getting over the fear of getting into trades, because that's a skill set that you have to have. So many people are fear. I was scared. When I first started trading, I was scared to death. I was scared. And I just started doing entries. I just did it because I needed to get over it. I was afraid as soon as I put in the trade, it was going to do what orange juice option did to me. It took half my money in one night. So I had to coach myself through doing lots of executions. And I got that idea from Larry Williams. He desensitized himself by trading, just taking trades, and just he didn't care. Just in. And I ended up doing that same thing. So, but I had to develop things to get in on the trades. And over years of doing it, I I was fearful that I was going to pick the wrong entry. So I understand that what you're trying to do is you're trying to avoid the losing trade, and you want the perfect precision entry with no drawdown. It'll never ever even imagine coming close to your stop loss, and everything's going to be good and easy. And that's what I was trying to do. That's why I have 81 entry mechanisms. And believe me, it's not bullshit. I have 81 ways to get into some kind of a fucking trade. I will get into it. I'm like a fucking burglar. Okay, I can break into any one of these fucking trades and rob their ass. I can do it. But not all of them are equal in its ability to take as much out as available. The higher up on the spectrum of that price run, whether it be premium or equilibrium, it will determine how much you can yield from it. But I can be in there, which is why when I pyramid and I build larger positions, all of that's done with having a greater understanding that came from me doing this for years, seeing it. These candlesticks are not doing anything different than they did when they were doing it in 1992. Think about that. Price is not doing anything differently today than it did before I was born. And I'll be 52 tomorrow. 52. And these markets, I have charts that are predated my birth, and they still do the same stuff. They do the same stuff. The only difference is it's much more cleaner to see and identify because we have 24-hour markets. Well, 23-hour markets because the indices stop trading for an hour. But it's become very clean, which makes it easier. And if they ever take away the new week opening gap, the new day opening gap, like say they take it away and say, okay, so it's going to be 24 hours trading. Who gives a shit? I don't need that because we have new week opening gaps and we have relative equal highs and relative equal lows. Like you're worried about things that's going to be no problem at all. So while you have these advantages, why aren't you using them? All the time and energy you're spending worrying about it's going to stop working. You know, they said that same stuff when I was on Baby Pips. Oh, this is going to stop working because he's teaching it. If you believe that, how many years has it been? 14 years. So you're going to wait around 14 years to see if you're right about it going to stop working? Instead of using it and making money and bettering your life and your family and preparing yourself for what's coming? Look around, folks. On Twitter, I said all kinds of stuff was going to be madhouse. We're in it now. Look at what's going on over UK. Look at Bangladesh. Look what's going to happen in the Middle East here soon. And all that stuff is going to be in all of our lives and worse. And in November, we'll see what we get here in the States. There's a lot of stuff coming, folks. And it's not meant to rush you. It's not meant to panic you. But, I'm doing what I can. There's too many of you to dole out money to you. That doesn't fix anything. So if I can teach you how to fish and give you a peace of mind, knowing that, even if you make your groceries every year, every month, what you spend on food, that's a blessing. That is a blessing. And my hope is that you'll do well with this and you can help somebody else that can't do it if they can't meet their bills, and you just help them. If I can give that mindset to all of you and just 10% of you do that, man, what a blessing that is. That really gives what I'm doing here a deeper sense of value. You think that it's just you that needs to make the money. I'm hoping to change the way you think about money. I want you to think of it as a tool that, yeah, you can make it and you can make more of it anytime you want. But you having it in the bank or leasing Lamborghinis and McLarens, all that bullshit, that is trash. All that stuff, nobody cares about it. After a while, nobody cares about it. And then it makes it feel worse because you have it still and nobody cares about it. But when you help somebody else and you give somebody a helping hand with, hey, look, I can see these people, they can't make their rent, they can't feed their family, or they may lose their job, maybe made redundant. The economy's getting ready, to tear everybody up. And just because we have millions of dollars in the upper percentage of everyone, like myself, I'm in the upper classification of an individual. I'm not poor, but I'm going to feel it just like everybody else will. I have to